It feels like every other day there's a new gold rush, doesn't it? Whether it's AI or crypto or some other tech boom. There's always this new frontier that promises, just incredible wealth if you're brave enough or maybe just early enough to get in on the action. And that dream, the idea of striking it rich, it's powerful. It's something we can all relate to.
But what are we really buying when we jump into these things? Well, according to some really interesting academic research from a credible source, the VU Research Portal, it's often not just a simple financial decision. We are, and this is the key part, buying hope. We're investing in the possibility of a better future. And that emotional pull, it can be way, way stronger than any cold, hard logic.
Okay, so that's the dream. But let's switch gears and look at the actual data. What really happens to all those hopeful miners who rush in to dig for digital gold, let's say, by day trading stocks or crypto? Well, the numbers, they paint a very, very different picture.
This one is pretty shocking. According to a study cited by TradeCity, a massive 80% of all day traders quit within just the first 2 years. Just let that sink in for a second. That means 4 out of every 5 people who give this a shot just walk away.
And it gets even tougher from there. Other academic research looking into this found that fewer than 1% of day traders actually manage to make a predictable profit once you factor in all the fees and costs. Less than 1 person out of 100.
And here's the real kicker. It's not just that most people aren't winning big, they're actually falling behind. On average, active traders end up underperforming a simple market index fund by about 6.5% every year. So all that effort, all that mining, actually puts them in a worse position than if they had just done nothing at all.
So this leads us to the big question, right? If the odds are this bad, why is the dream so powerful? Why do so many people keep grabbing their virtual pickaxes and rushing in when all the data shows that the mine is pretty much empty?
And hey, by the way, if you're finding this breakdown interesting, it would be awesome if you could take just a second to like this and subscribe. It honestly helps us a ton and lets us keep making more of these explainers for you. Thanks.
Okay, so the answer to that huge question isn't really out there in the market. It's actually a lot closer to home. It's inside our own heads. You can think of our brains as having this operating system. And sometimes it's got a few bugs, especially when it comes to money.
Now, psychologists have a name for these glitches: cognitive biases. This definition actually comes from a solid academic paper called Cognitive Biases in Financial Decision-Making, and really all it means is that they're mental shortcuts. Our brains use them to make decisions faster, and most of the time they're super helpful. But with money, oh man, they can lead us into some pretty big mistakes.
Let's look at just a couple of big ones. First up, you've got something called loss aversion. This is the simple fact that we hate losing money way more than we enjoy making the same amount. It's why people will cling to a losing investment, just praying it'll turn around. And then there's overconfidence. This is that little voice in your head that says, yeah, sure, 99% of people fail, but that's them, I'm different. It's the glitch that makes us think we're the exception to the rule.
So, if digging for gold yourself is so risky, what's the other option? Well, this takes us to a much older and frankly much smarter strategy. Instead of being the miner, you sell the picks and shovels.
This whole idea comes directly from the California gold rush back in the 1800s. See, the people who made the most reliable fortunes weren't the miners. Nope, it was the folks who sold them all the stuff they needed. The picks, the shovels, the wheelbarrows, even the sturdy denim pants. They made money from the frenzy of the gold rush itself, no matter who actually found gold. And when you put the two side by side, the difference is just crystal clear. The miner is taking a huge risk, betting everything on one lucky strike. But the shovel seller, their business is so much more stable. They profit from the activity. It doesn't matter if a miner finds gold or goes bust. Either way, that miner needed to buy a shovel first. That's consistent demand.
And this isn't just some old-timey history lesson. Today's shovel sellers are everywhere. Think about the AI boom. The shovel sellers are the companies making the computer chips that power it all. In the crypto craze, it was the exchanges that took a small fee on every single trade, whether the price went up or down. They're the ones providing the essential tools and infrastructure for the whole industry.
Now, to really get why the miner's life is so exhausting, we're going to borrow a really cool idea from evolutionary biology. It perfectly explains the brutal competition we see today.
This line might sound familiar. It's from Lewis Carroll's Through the Looking Glass. The Red Queen explains to Alice that in her kingdom, you have to run as fast as you possibly can just to stay in the same spot. And this idea, it turned out to be a perfect metaphor for competition.
In the world of business, it's called the Red Queen effect.
It's a well-documented concept with a lot of academic work from researchers like Barnett and Sorensen. Basically, it describes a competitive arms race. One company gets a little bit ahead, and immediately all its rivals have to adapt just to catch up. It's a non-stop cycle of innovation where you're not trying to get ahead, you're just trying not to fall behind.
Here's how that cycle works. A company comes up with a great idea, and for a minute, they have an edge. But then, everyone else is forced to copy them or one-up them. Suddenly, that original advantage is gone, and now the pace for the entire industry has just gotten faster, making it even harder for anyone to get a lasting lead. This is the race that every miner is stuck in.
All right, let's pull all these threads together. You've got the emotional dream of the gold rush, the cold hard stats that say it's a terrible bet, the mental glitches in our brains that keep us trying anyway, and this relentless Red Queen effect that makes winning almost impossible to sustain.
And here it is, the main takeaway. The Red Queen effect is the race. It's that frantic running just to stay in the same place. The genius of the picks and shovels strategy is that you're not trying to win the race. You've stepped off the track completely, and you're profiting by selling running shoes to all the runners.
So, the next time you see a new boom starting up, and trust me, there will always be a next one, this gives you a really powerful question to ask yourself. Are you going to be the one grabbing a pan and running for the river, fueled by hope and those mental glitches? Or are you going to be the one on the riverbank calmly selling the pans?